But I think what's even more significant is a long overdue realization that the U.S. cannot possibly repay its debt, honestly. That the national debt, which is now $38 trillion, and of course, that's just the bonded debt, not with all the unfunded liabilities, but the treasuries that a lot of foreign central banks own, there's no way the U.S. government can repay that debt in money that isn't dramatically debased, meaning that the U.S. government will not be able to raise sufficient tax revenue to make good on its obligations. The Fed is going to have to print the money. And also, we have so much debt now that we can't even afford to pay a rate of interest that would be commensurate to the loss of purchasing power that you might experience holding U.S. debt to maturity. And, that's why Donald Trump is beating up the Fed to cut rates. In fact, that's why the Fed is cutting rates, even though inflation is well north of their, bogus 2% target and headed higher, right? They're cutting rates when they should be hiking rates. And it's mainly because we can't afford the rates that we have now, let alone the rates that would be required to restore inflation to 2%, right? So we're cutting rates, but we're letting our creditors know that if you hold dollar or treasuries, you're going to lose. We are going to debase what you're holding, and we're not going to pay you a rate of interest that's anywhere near close to compensating you for what you're going to lose to inflation. And so I think given that, the world has made a decision to get out of dollars. And so I think you're going to see the weakness in the dollar against other fiat currencies. I mean, clearly, when gold is at 4,000 and it was at 2,000 2 years ago, the dollar's lost half of its purchasing power in terms of how much gold you can buy with your dollar. So the dollar is losing value against real money right now, but so are the pound and the euro and the yen and all these other currencies. But I do think that you're going to start to see the dollar losing a lot more value relative to its fiat counterparts, either before the end of this year or next year, and that's going to accelerate the increase in the price of gold in dollar terms. But I think it's already giving you a forewarning that that's going to happen. I think gold is rising as a reflection of a loss of confidence in the dollar, because I think the main reason that gold is being accumulated is because central banks have lost confidence in the dollar and in the fiscal responsibility of the U.S. government or the credibility of the Federal Reserve. So you're seeing it first in gold. I think you'll next see it in the dollar, and then I think you'll see it after that in the Treasury market, where you'll start to see a big drop in bond prices and a rise in long-term yields, despite the fact that the Fed is going to be reducing short-term rates. And I think that is going to be the catalyst for a return to quantitative easing, because I think the Fed is going to try to lower long-term interest rates through its open market operations, where it needs to print money to buy the bonds that the rest of the world is selling. And so that, I think, will be another catalyst to drive gold to even higher levels, because that's just massive inflation. And, the last couple of times we tried QE, inflation, at least the way the government purports to measure it, was below 2%. So the government was able to justify QE by saying, look, inflation is below target. And so we could do this because the goal is to get inflation higher to reach our target. And so, we're going to accomplish that with QE. But if inflation is already well above 2%, what is the excuse for creating more inflation? How do you justify QE when inflation is 4 or 5%? That's the way the government measures it. I don't think they could do that, because just moving it to 3%, once you move the goalpost once, right? Well, now you've already broken trust, because if you can move it to 3, you can move it to 4. But even moving it to 3, is a big game changer, because that means a 50% increase in annual inflation. So, what does that do to the present value of gold if inflation is going to be 50% higher from now until the end of time? But of course, they're not going to achieve 3, because if they give up 2 and they move to 3, well, then they're going to give up 3. They've already proven that their target is BS when they're above it. They don't have the monetary cojones to do what it takes to bring inflation down to 2%. Well, then why would they have it to bring it down to 3%? Or 4%. So I think, once they move it, they're done, which is why they probably won't. I don't know that they're officially ever going to say that they have a target of 3. I think they're going to keep a target of 2, but they're just never going to hit it. And I thought it was really ridiculous. In the last FOMC meeting, somebody actually asked Powell about about his forecast, because he pointed out, hey, 2 years ago, you predicted that in 2 years, inflation would be 2%. And now it's 2 years later, and it's way above 2%. And you're still predicting that 2% will have 2% inflation in 2 years. And he said, why should we believe you? I mean, what makes you more confident now than you were 2 years ago when you made the same prediction? And Powell basically said, look, we don't really know where inflation is going to be in 2 years. It's just that 2% is our target. So that's our forecast. We just assume that we're going to hit our target, but we have no idea. So in other words, they just make it up. The only reason they forecast 2% is because they want it to be 2%, not because they think it's going to be 2% or they have any reason to believe that it's going to be 2%. So they could just keep on talking 2% inflation, just to pretend that they've got that target. But, we're not going to go anywhere near it. What they may do to try to get closer to 2% is not change the target, but change the CPI. I mean, that's how the government operates, right? You change the methodology for calculating the CPI so that you get a lower number. That's what they did with the Boskin Commission. That's why the whole CPI is irrelevant today, because it's been rigged by the government to have a low number.
One of the most significant realizations finally starting to dawn on people, and it's long overdue, is that the United States cannot and will not ever repay its debt honestly. I'm not talking about the spin, the rhetoric, or the political theater in Washington. I'm talking about the math. It's simple arithmetic. The national debt has blown past $38 trillion, and that's just the bonded on-balance sheet debt. It doesn't even count the unfunded liabilities. The Social Security promises, Medicare obligations, government pensions. When you add all that up, you're talking well north of $100 trillion in total commitments. That number is so absurd that people's eyes glaze over. But for every foreign central bank sitting on a pile of U.S. treasuries, it means the same thing. There is no possible way the U.S. can make good on those IOUs in money that retains its purchasing power. What does that mean in plain English? It means we're going to pay them back in dollars that buy a lot less than they do today. Debasement is the only politically viable path forward. The U.S. government cannot raise taxes high enough to cover its obligations, not without triggering an economic depression that would make the 1930s look like a picnic. So what's the only remaining lever? The Federal Reserve. It has to print. It will print. It's already printing. And here's the irony. The more debt we pile on, the less we can afford to let interest rates reflect reality. If we actually allowed rates to rise to a level that compensated investors for inflation and risk, say 6% or 7%, the U.S. government would go bankrupt overnight. The interest bill alone would blow out the deficit by another couple of $1 trillion. So instead, we've reached this absurd situation where the Fed is cutting rates while inflation remains well north of its so-called 2% target. You can thank both Donald Trump and Joe Biden for this bipartisan insanity. Trump, even when inflation was rising, was already yelling at Jerome Powell to slash rates and juice the markets. Now Powell's doing it voluntarily, cutting rates when he should be hiking, because the Treasury market can't handle the truth. We simply can't afford the rates that would actually restore purchasing power to the dollar. What message does that send to our creditors? It tells them exactly what they already suspect, that holding dollars or treasuries is a guaranteed losing trade. They're being promised repayment in currency the U.S. government fully intends to debase, and the interest they're earning isn't remotely close to compensating for that loss. So what happens? The rest of the world starts quietly backing away. They don't make a big announcement. They just stop showing up at the auctions. We're watching it happen right now. Foreign holdings of treasuries have dropped from about half of the total market a decade ago to just 30% today. That's an enormous shift in global capital flow. The world has made its decision. It's getting out of dollars, and you can already see the effects in gold. 2 years ago, gold was hovering around $2,000 an ounce. Today, it's above $4,000. Think about what that means. The dollar has lost half its purchasing power against real money, gold, in just 2 years. Half. But don't think for a second that this is just a gold rally. It's a vote of no confidence in the US currency itself. And it's not just the dollar losing ground. The pound, the euro, the yen, they're all in the same sinking fiat boat. The only difference is that the dollar's boat is bigger and sinking slower. But sooner or later, it's going to take on water too. And when that happens, when the dollar starts falling, not just against gold, but against other fiat currencies, that's when you'll see the real acceleration in gold's rise in dollar terms. You don't have to be an economist to see it. Gold is already warning us. It's the canary in the coal mine. It's signaling a breakdown in global confidence, not just in the dollar, but in the fiscal and monetary discipline of the entire US establishment. Central banks understand this. That's why they're dumping treasuries and stockpiling gold. They know that the era of trusting the full faith and credit of the US government is over.
Yeah, well, first of all, the peak in 1980, that's when gold went from $35 to $850. So that is an enormous move. I mean, we're not even close to that, that type of move this time. And in fact, even the 2011 peak, gold started that run about 10 years earlier at around 250. So we went from 250 to 1900. And if you figure this run, we broke out at 2000 was the highs. And, we've gone maybe double from 2000. So it's not anywhere near the type of rally that we've saw in the past. And even if you measure it from the low of the correction after it hit 1900, we're only about a 4x move from that low when gold pulled back to 1050. So I think even relative to those other big moves, this one is still pretty early. I think it has a ways to go. But yeah, I mean, gold had started to move up very rapidly. So it doesn't surprise me that it pulled back. I mean, it was a pretty violent pullback. We had a 6.5% decline just in one day. And of course, the biggest moves in bull markets, and that this goes with anything, not just gold, but in stocks or, it's always the downside, right? In a bull market, the biggest moves are down. Like in a bear market, the biggest moves are up. And they generally shake out the weaker players. They create a lot of fear that, it's over, time to get out. And they're usually very violent, but they end very quickly. And while a lot of people are frightened of the move, they end up missing out on the opportunity to buy. And I think that's going to be the case with this shakeout. I think gold is going to keep moving up. I think, it's probably healthy that we had a big pullback to kind of keep the speculators in check. The people who come in on leverage and use tight stops, a lot of those guys probably got flushed out in the pullback. We had a big drop in the mining stocks, far more than we did in the price of gold. In fact, a lot of mining stocks ended up losing all the gains, I think, since about 3,700 gold, even though gold is now about 4,100 and change. And there are many gold stocks that are already in bear markets, technically, that in a couple of days have dropped by 20%, as if, everything is falling apart. But we're above 4,000. I think it's interesting that the low of the pullback so far was still above 4,000. So when you're talking about we had this huge sell-off, but gold was still above 4,000. I mean, we didn't sell off from 4,000. We sold off to 4,000.
The U.S. economy is trapped in a vicious feedback loop, and the only way out, at least politically, is through inflation. Let's break this down. We've got record debt, record deficits, and record entitlements. We're borrowing over $2 trillion a year just to stay open, and that's before any new wars, pandemics, or bailouts. The Fed can pretend to normalize policy, but every time it even hints at tightening, the system starts cracking. We saw it in 2018 when the markets had a tantrum. We saw it in 2023 when regional banks started failing. Every time yields rise, something in the plumbing breaks. That's the curse of a debt-addicted economy. Higher rates are like poison, so the Fed will always flinch first. It has to. Now, the political class won't admit this, but deep down, they understand it. That's why every administration, regardless of party, runs bigger deficits and pressures the Fed to monetize them. Trump did it, Biden's doing it, and whoever wins in 2028 will do it again. Because the math doesn't care who's in the White House. And yet, despite all this, people still talk about soft landings and deficits don't matter. That's like watching someone jump out of a plane without a parachute and arguing about what brand of shoes he's wearing on the way down. The landing's going to be hard no matter what. Now let's talk about what this means for gold, because that's really the only asset class that understands this madness. Gold isn't rising because it's speculative. It's rising because it's rediscovering its role as the ultimate counterparty insurance. It's rising because people, central banks especially, are realizing that the dollar system is dying of its own success. When gold hit $4,000, the mainstream financial media treated it like a curiosity. Wow, new highs. Who could have seen that coming? Well, anyone who's been paying attention could have seen it coming. Central banks have been buying record amounts of gold for 5 years straight. China has been aggressively adding to its reserves month after month without fail. Poland, Turkey, Singapore, even Saudi Arabia, all adding gold. Why? Because they understand that in the next monetary reset, credibility won't be measured in GDP or military strength. It'll be measured in tangible reserves. Meanwhile, the U.S. keeps exporting debt and importing inflation. The exorbitant privilege of issuing the world's reserve currency has turned into a slow poison. For decades, it allowed America to consume more than it produced. Now it's forcing the U.S. to print more just to sustain the illusion. The world is catching on, and they're quietly opting out. And let's be clear, this isn't about hating America. It's about math and incentives. If you're a central bank holding dollars, you're watching your purchasing power evaporate. You're watching Washington weaponize the financial system, freezing Russian reserves, sanctioning anyone who dares step out of line. So what do? You reduce your exposure. You diversify. You buy gold, something that can't be canceled, hacked, or printed. This process isn't speculative, it's strategic, and it's not going to stop. Now let's shift to the Fed again, because this is where the comedy turns tragic. The Federal Reserve has trapped itself in its own narrative. It pretends to fight inflation, but it can't do it without imploding the government's balance sheet. It pretends to manage expectations, but those expectations are already broken. People no longer believe inflation will ever be 2%. They believe it'll just be whatever it is. And that's far more dangerous, because once inflation psychology sets in, once people start expecting their dollars to buy less next month than this month, you can't put that genie back in the bottle. And don't expect the Fed to save you. They're not even being honest. Their inflation models are so flawed that they might as well be rolling dice. Their dual mandate is really a single goal: keep the bubble alive. Meanwhile, the bond market, that supposed smart money, is starting to push back. Long-term yields are creeping higher, even as the Fed cuts short-term rates. That's the market calling the Fed's bluff. That's investors saying, we don't believe you can control inflation, so we're demanding a premium for risk. When that dynamic fully takes hold, you'll have the Fed cutting rates into rising yields. The ultimate signal that confidence is dead. And when confidence dies, gold becomes the only asset left standing. Look, I've been talking about this for years, and for most of that time, people laughed. Gold's old-fashioned. It doesn't pay interest. It's a barbarous relic. Yeah, well, so is fiscal sanity, and I'd argue that's far more valuable, because when your so-called safe assets are guaranteed losers in real terms, the asset that just sits there and holds its value looks brilliant. We're heading into a period where the Fed's choices will be reduced to two bad options: let the system implode under its own debt, or destroy the currency trying to prevent it. Either way, gold wins. Now you might be thinking, all right, Peter, but what about Bitcoin? Good question. Bitcoin in theory is digital gold, but in practice it's a speculative asset that trades like a tech stock. It's driven by liquidity, not scarcity. When the Fed tightens, Bitcoin falls. When the Fed prints, Bitcoin rises. That tells you it's not a hedge against monetary insanity. It's a symptom of it. Gold, on the other hand, doesn't need a bull market and risk assets to rise. It thrives when trust collapses. And that's where we are now. At the point of trust erosion, not just in the dollar, but in the very institutions that back it. The Fed, the Treasury, the government, all of them are being exposed as debt addicts who can't stop. Now what comes next is predictable. QE4, QE5, maybe even yield curve control. And every round will push gold higher, not linearly, but exponentially. Because each time, fewer people will believe the Fed story. Each time, the world will price in more risk. At some point, and it's not far off, gold will stop being a trade and start being the benchmark. The financial system will need an anchor again, and the only asset with the credibility and neutrality to play that role is gold. Central banks know it. That's why they're buying. The irony is that when this shift finally happens, the same pundits who mock gold for decades will claim they saw it coming. They'll say, of course gold revalued higher. The fundamentals were clear. But they're the same people who laughed when it was $1,200, who said, you can't eat gold when it was $2,000, and who said it was dead money at $3,000. Meanwhile, gold quietly doubled again. And you, if you understood the game, didn't just survive. You preserved your wealth while the rest of the system burned itself out. That's where we are now. The US is approaching a dead event horizon. The Fed is out of ammunition. Inflation is no longer a bug. It's the business model. The dollar is in structural decline. And gold? Gold is just doing what it always does when paper promises collapse, revealing the truth. So don't wait for the headlines. Don't wait for Powell to admit the obvious. Gold doesn't need permission to rise. It just needs time. And time, my friends, is running out for the dollar.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.